Wednesday, everybody. Welcome to the closing beat. How you doing today? Good? How's he doing? He's doing good. Hey, welcome. We're financial advisors here at Jazz Wealth. Pleasure to be here. I couldn't do it yesterday. It's like, you know what? You guys with your GameStop and your AMC, I'm out. I'm not. You want to focus on that? No show. You know. No, I'm good. Good to be here. Happy to be back. Thinking about, by the way, I think I'm gonna get the hair stuff done.
What? Why?
I think I'm gonna have the boop boop and get the hair stuff.
You don't need that.
I think I do. Yeah, I think I'm gonna get it done. I'm just teasing. I'm actually trying to take a little of the heat away from Eric from Swamp Rat.
Oh, yeah.
Maybe he'll hit me with something there. Put more of the attention on me. I feel bad, man. He's going after him there. Hey, anyways, market-wise, that's what we're here to talk about. We're like the only advisors that can talk about that, or that will talk about it. Maybe other people can, and they just don't want to do it. We got a lot of cool stuff here to share with you today. Our Wine and Wealth class last week was with Eric doing an overview there, and the week before that was your May financial focus and the sell in May and go away. What does it mean? Come on, what data are we using here to do that? So if you want to go check that out, you certainly can. The big information, the big thing today, which was kind of weird because the other economic numbers weren't so good. If you look at manufacturing and forward expectations there. Ooh, not pretty, but nobody cared. They said, oh, wait a minute. Inflation, core CPI, not headline, but core CPI comes in 0.29% month over month. All right, fine. Obviously, that's good. People want to see that because it means inflation didn't actually go up like we're at the moment, like everybody was thinking. So the rate cuts are still on the table. There's a projected 1.5, call it 2 rate cuts this year. We'll cover that a little bit more later. Inside of that report, though, what I thought was cool, because like you're consumers too, right? So inside of that report, we found used cars, new car prices down. All right, fine. We found that rents overall hit a 31-month low. So if you're out there renting, that's kind of cool information out there. And if you notice, healthcare stocks were down a little bit, or at least underperforming today. It's because healthcare insurance. All right, we're finally seeing that kind of peak out there just a little bit. I don't know if that continues, but it's what you got. So for the S&P here, we got a move to new highs there. And actually, the S&P is in first place year to date now, about 11% gains there. And if you're looking around, it's going to be the large cap growth areas that got all the attention. If you want to look at something like the tech sector is the leading sector today, 2.3%. Actually, no sector lost money today. The worst would be consumer staples, and that was still up basically 0.1%, right? So looking around, that's where all your action was, whether you're in small cap growth, mid cap growth, large cap growth, all of that was where the action was. Large cap growth getting all of the attention. And of course, that's the big names, you know. And that's the thought, by the way. So if you know, I'm a little side topic here. If you know that the broad index is heavily weighted towards the magnificent set, whatever we're calling them today, NVIDIA, Microsoft, Apple, Amazon, Tesla in there as well, but basically NVIDIA, Apple, and Microsoft and Alphabet, you put those guys in the group, and that's going to lift the market, right? So think about it as an investor. You get good news, or short-term trader, swing trader, whatever. If you get really good news, you think the market's going to be strong, you could either A, hope that the whole market is strong and go towards like the S&P as an index, or the NASDAQ or whatever, or B, you could go inside of it and say, well, if it's going to be a strong day, I know that it has to be including NVIDIA, Apple, Microsoft, Alphabet, so why don't I just buy those, right? And that's kind of what happened today. So if you're digging a little bit deeper on all that stuff, that's what you got. If we look at the Dow up here using the ETF so you can follow along as well, it's a stone's throw away from 40,000. That'd be 400 on this if you're using the ETF, the DIA, to take a look at that. It's in third place year to date there. It's fine. The Russell 2000 was led today by tech, biotech, and industrials. The Russell 2000 is not weighted the same. Actually, that might be a good lesson to do, right? The Russell 2000 moves differently. So tech is obviously a part of it, but not as much in the S&P. We'll go back to something like that. It's in last place year to date, though. It's up 5%. Basically, and rates are to blame, right? Why is the Russell 2000 more sensitive to rates? All right, we talked about this a little bit, but what's going on inside of there? Let's do it this way. Okay, if we look at the Russell 2000 and the S&P 500, right? So you can see them both here. we're looking at the debt related to these companies. Well, 63% of the Russell 2000 has fixed debt that doesn't mature until beyond 2026, which is when most people expect the Fed rate to hit its terminal rate, around 3.25, 3.5, meaning the rate that it stays at for a while. Where they stop cutting. And then we say, well, 7% of it has debt that's maturing inside of potential rate cuts. So if those get delayed, that's not so good news there. And 30% of it has variable rate debt. Think of your home equity line of credit, your credit cards or whatever. Not that they have credit cards, but you get what I'm saying. The rates can fluctuate and adjust quarter by quarter, year over year, depending on the debt that they have. Well, inside the S&P, 81% of these larger companies have been able to negotiate better debt, fixed debt. Maybe it's individual offerings that they're doing, right? So they can do that. Only 6% of it is variable debt. 6% of companies in the S&P have debt that equals out to be variable in nature. So think about it for a second. The Russell 2000's lagging behind, not necessarily in the last couple of days, but overall, year to date, it's lagging behind. If you see the inflation number today and you believe that that's going to continue and the Fed will do their 1 or 2 rate cuts this year, and then quarter after quarter next year will continue to cut rates until they reach their terminal rate. Sorry if this is boring. But if you think that, and you know that that's going to help 30% of the Russell 2000, then wouldn't the Russell 2000 be something to be more focused on, right? Maybe it plays catch up. Right? Or if there's a pullback, maybe that pullback comes on higher rates, and then now you say, oh, buy them for a discount. So I wanted to kind of point that out. It's not necessarily something we would spend a lot of time on, but think in terms of that. What did the news tell you today? And what sort of data can I use to go, oh, maybe, no, I don't want to look at NVIDIA, right? What does that matter? They've got fixed debt and they can get whatever they want at this point. I want to look at the companies that maybe have struggled a little bit, but now we'll start seeing that tailwind change, right, from a headwind, and go from there. All right. What else do we want to? There's not much else to cover there. If you're looking around the markets today, every sector was up. It was a good day. I don't know what else I can say about that. All right, do a quick lesson. Should you buy and hold a stock forever? A stock, not an ETF, a mutual fund, an index fund, whatever. I'm talking about a stock. Because there's a lot of talk of this, well, your GameStop and AMC, you got NVIDIA in there. People are saying this is it, it's going to conquer forever. Well, stocks move based on earnings growth, right? So if we're seeing strong earnings growth, strong projected earnings growth, and then we're hitting those numbers, that's where you see the performance. The stock market actually moves higher over the long term based on the earnings growth of the companies that are inside the index. So how often do companies achieve strong earnings growth? Well, I've shared this with you before. So we take a look inside of here. What we're doing is we're saying year after year after year, how many companies in the S&P can show me 10% plus sales growth, right? So year number 1, 91% of companies can do that, right? You can have that. So we're taking everything into consideration here. But to do it 2 years in a row, all of a sudden we lose some people, okay? Remember, you're buying stocks based on earnings growth. That doesn't mean there's no growth. It just means it's not as many of them growing double digits, right? As we get into year 3, we see that severe drop-off. Kind of looks like a car valuation slide, right? So we get 39%, 31%, 26%, and so on and so on. Again, it doesn't mean that they didn't have double-digit growth, but you could see that you have a smaller and smaller and smaller pool to choose from. Have you ever noticed that an ETF, well, a mutual fund, right? They'll own a whole list of stocks and they don't sell them. Like, they just doesn't go away one day, but they reduce the size of the position and it shifts to the bottom. Then there's another one that shifts up and then one goes down. If you look into that, they're chasing growth, right? It gets harder and harder to do that. So they reduce the size of the positions in the years where the growth isn't quite there, and then they'll increase it in the other years. Well, 20% sales growth is even harder. 72%, 43, 23, and we start drifting down to this, next to nothing. To have a stock for 10 years that posts double-digit growth, and in this case 20%, to where you would expect to see an increase in value of that stock over and over and over and over again. We did a game last time I brought that up. In fact, there's only one company that has ever made it 10 years with double-digit growth, and everybody took a shot and guessed. Nobody guessed it. It was ServiceNow, ticker symbol NOW. That's the only company ever in the S&P's history to do that based on what we have there. So the point of that being, do you hold a stock forever? Maybe, but maybe you don't hold the same weight. In the years where it's growing, everything looks good, as things are doing better and better and better, reduce the position size. As they have an off year, there's a recession inevitably or whatever, all right, we reduce the position size. We'll use that to add back on discounts and things. That's how they do that in those mutual funds. Anyways, that was a long story. Let's go on to stocks in the news. We're going to do it. AMC. So, yeah, you see it there. And I'm not getting oh, that is the latest. So AMC, they got you again, right? They did this before. Do you remember, oh gosh, way back when this whole meme stock thing was crazed? We said, well, what is AMC doing? And remember we talked about a shelf offering. We went through the whole thing. What is a shelf offering? AMC was no dummies here. They actually have a really good guy running the company. At the time they did. And what they did is they said, okay, this is going great. We want to sell more shares. If people want to buy the shares, then as a company, we want to give them more shares at this stupid valuation, and we'll end up taking in more money, and maybe we can survive. So they did what's called a shelf offering, which is basically a blanket statement to the SEC going, we want to sell all of these shares. We don't want to do it now. We just want the right, the ability, the registration to offer these shares. What we're going to do is choose not to do it now, and we're going to put them on the shelf. So what it means is they do all the paperwork, all the legal stuff. They get the stamp. Well, they don't get a stamp of approval from the SEC, but they let them know. And they say, okay, well, you're allowed to do this. Then they put all those shares on a shelf, and they sit back and they wait. Because when you guys panic or freak out or whatever you're doing now, and the stock shoots up, they just simply go, we'll take some of them shares. There you go. They don't have to register them. They don't have to say anything. There's nothing. They could just do it. They did it yesterday. So they took some of those shares off the shelf and they were like, hey, you guys are stupid. And they sold you the shares. What do you think pushed the stock price down? They sold so many shares to you guys. It's incredible. I'm not saying every one of you, but the people that fell for that. So you got caught by the shelf offering. That's there's the lesson you won't hear from somebody else, right? All right, moving on. I only have a couple other names, and this is really just a lesson in general. Dynatrace, you probably don't look at them, or maybe it's not something you've ever considered. They had a good day today. All right, let's move on. Hold on a second. Nope, I typed the wrong one. GSM, there we go. Still getting used to this one here. Ferroglobe, these guys make like specialty metals and things that are chemistry that I don't understand. Anyways, hey, that stock was up today. It's a good day for them. What happened? Well, we're just following through with the lessons that we teach, to teach you ahead of time, see it happen, and then go and say, well, what's the lesson? Well, remember, both of these stocks actually did buybacks. And now they're not big companies. You got $500 million buyback and a $200 million buyback. But remember this slide right here. It's been updated. What stocks do investors reward the most based on how the company uses their money and where we're at in the economic cycle? We are here, red dot. So if we're in the middle of a flattening to slow down, we reward, or investors historically, this is not a guess, right? They reward companies with balance sheet strength. In fact, the biggest reward right now is if you put a portfolio together of companies that have strong and strengthening balance sheets, they're doing the best out of all of them. And then this one here, returning cash to shareholders. We do not reward you buying other companies, merging with one company, buying new equipment and things like that. We reward you giving us money back when times are slowing down. That's what we want. That's how you know where we're at in the cycle. That's, or at least where people believe. So another two names, buying back shares. Hey, guess what happened? All is good there. All right, next up and last up here, Alphabet. So really cool what's going on with them. They're spending their whole conference talking about AI. And one of the cool things I thought, which is sort of, not accretive, but like where they can make money from it, is they call it agentive experience, where they're creating these kind of AI models that are agents, and one of them is even video. It's really cool, where you can use it for interaction, right? It'll learn from everything, not just general AI, but to be a little agent. Send it out and do its thing and whatever you want. So one of the cool things I thought, this is a side topic, but they showed a video of a girl on her phone, and she's like filming stuff, and she's like, tell me when you see something that makes noise. and it saw the speaker and it goes, there, the speaker, it makes noise, right? And then she's like, hey, do you remember where I left my glasses? And it's like, it's on the table back there next to the red apple. And she like turns around and there it was. I thought that was so cool. So anyways, if you're into that geeky stuff like that, they announced that with a whole host of other things going forward, and their expansion into that area. They're really diving off there. And they even included it in Maps, Google Search, YouTube. Really cool stuff that they're creating out there. What else do we got? Tomorrow, we're getting to that point where, we mentioned JD.com earnings coming out there, Baidu, and then we get into the retail side of things like Under Armour, Walmart, a whole bunch of others. After hours, the focus will probably be on Applied Materials. In the morning, it'll be on Walmart. And we'll see what happens there. Do we need to do the update? Do we?
Can. Yeah, I don't have the updated version there, but we got Ryan, Ermias, Tony, Victor, and Tommy. That's your top 5 for today. And I actually just wanted to follow up with Jim Cramer right now. Great follow on Twitter. If maybe you are outside of the game, Stop World. He actually touched on what you talked about. He just said it in a little bit more of a sarcastic tone. He said, can you believe that AMC issued enough stock to cover $164 million of debt? What a mean buzzkill. You would think that they would let the stock run, but maybe avoiding bankruptcy is a better option than letting the buyers win. Thank heavens GME has a great balance sheet. He's got a lot of sarcasm in there. His whole Twitter feed for the last 48 hours.
So yeah, not much of a lesson, but there's your confirmation that maybe it's not the best thing for them to do, but they literally just were like, stocks up, take some shares, sell, put a bunch of money in their pockets. I mean, I wish them well, I guess. It's just not going to work out. All right, let's take your questions. If you have any questions, we'll see what we can do. And then get on my way here. Get back to work there. No rate hikes before. No rate hike. No. Well, you don't really. You don't have a good reason for a rate hike after today's numbers. Believe it or not, everybody still thinks that the first rate cut's going to be in July. That I don't know about. You know, but you also won't see many changes going into the election. Yeah. We got it. Wine and wealth topic? No, that's not tonight. That'll be tomorrow night. Last week was Eric's review, the May financial focus, the sell in May and go away. And I have some ideas what I'm thinking because I do that. I just like start focusing on, data and then how can I make a class out of that? But no, nothing yet. You still believe in the election year data? As an average, yeah. I mean, what do you have to work with there? Do you feel a little bit like the rug might get pulled out behind you a little bit with what happened today? I wasn't going to go there, but you feel that a little bit? With the new rate outlook, do you still think the market will pull back to flat year to date before election? Actually, the sort of average estimate for the market this year is 5,200 on the S&P. So that would still give it a nice year, but not much, or not higher from here, obviously. So I don't know. Oh, the good news is we're getting some debates, right? They said they're going to debate. This will be 2 debates, I think. I saw how they did that and go right around Mr. Kennedy. No, you can't do it now. These two now said, we'll debate on our own. We're not going to be a part of the commission. So that was probably strategery on both of their parts. Good luck, Do a portfolio update. We can include that. Yeah. Yeah, I like it. Sounds good. All right. Well, I'll wrap it up from there. I didn't want to make today like a whole lot. There's not a lot broadly to talk about. And by the way, if you want to look at like commodities, copper, what the heck's going on over there? Kind of fun to look at. All right, you guys enjoy the rest of your day or evening, and thanks for watching. See you later.